Alright, now we clearly understand that money today is more valuable than money in future, right? So next question is, how do we actually measure the difference? And this is where our next concept come in, the present value of money. Okay, let me give you a situation. Imagine I tell you I will give you 1000 after 3 years. Okay, it sounds good, right? But wait, let think like an let us think like an finance student. Is that 1000 after 3 years really equal to 1000 today? So the answer is no. Why? Because it is actually less valuable than today. And the present value help us to calculate how much it is less. What it tells us? That how much it is less. Okay. So the present value answers one simple question. What was that? That what is the value today of money that will receive in the future? In other words, we can also say it convert future money into today's value. That what is the value of money today? Okay, or this process we called it a discounting. The process when we convert future money into today's value, we called it discounting. Okay, so think about this logically. Okay, if someone offers you 1000 today or 1000 after 3 years, you will always prefer today. So the future amount must be reduced to make it comparable to today. That reduction, that reduce in the value is our present value. Okay, so this is the formula of how we calculate present value of money. Now let us take an example that you are going to receive $1000 after 3 years. Okay, our required return is 8% per year. Now instead of jumping into any calculation, let us understand it logically first. Okay, now ask yourself, if I had money today, how much should I invest so that it became $1000 after 3 years? Okay, so that amount is our present value. Okay, now if we will calculate, we will got the present value comes out to be our approximately 793.83, means the value of $1000 is after 3 years is 793.83. Correct? Now this is the most important part, that what does this number actually mean? What it is saying, what it is telling to us? It means if someone offers you $1000 after 3 years, you should not be willing to pay more than $793.83. Correct? So at this point, you might be thinking, why not to pay $1000 today and just wait? So that is a good question. That because if you invest $793 today at 8%, it will automatically grow to $1000 in 3 years. Okay, so both options are equal. But if you pay $1000 today, you are actually losing the money. Got it? So this concept is used everywhere, like buying a bond, investing in projects, deciding loan values, stock valuations, like that. So every time money is received in the future, we convert into the present value. What is the present value of that money? Okay. Now, some important points are, that interest rate effect. Interest rate effect that shows higher the interest rate, it means lower the present value. But why? Because money grows faster, correct? So you need less today, right? Next reason is time effect. If time is longer, then the present value is less. Why? Because money has more time to grow, correct? Okay. So now let me ask you something. If I say $1,000 after 1 year or $1,000 after 10 years, which one has the higher present value? Of course, the one after the 1 year, correct? Because it is the closer in time. I already told you, no? The time effect, longer the time period, lower the present value. So our time is less in first one. So we will choose first one because it is closer in time. Got it? Now one thing always remember that future money is not equal to the present value of money. We must always convert it before comparing. Correct? So in the previous slide, we learned money today is more valuable, and now we learn how to calculate that value. Got it? I hope you understand that. Now we understand, we already understand that what is the present value of money. Okay, okay. Now, so present value help us answer one very important question, that how much is the future money worth today? And this is the base of in our decisions, the three major decisions that are investment decision, financial decision, and the business valuation, or we can say the dividend decisions. Okay, now that we know how to bring money backward in time, next question is, how does money grow forward in time? And that is what we will study in our next lecture, that is future value. Okay, let us continue.